Other expense items must now be added. So they would be subtracted from gross profits to arrive at net profit. It would be earnings before taxes, which are general and administrative expenses, interest expenses, all subtracted from gross profit, and after-tax income, which taxes would be deducted from earnings before taxes, and then contribution to retained earnings, which would be the dividends deducted from after-tax income. Here is an actual pro forma income statement. Please look at the format in the line items included, beginning with sales revenue and ending with a bottom line of an increase in retained earnings. The cash budget is a summary of expected cash receipts and disbursements for a specific period of time. The pro forma income statement needs to be translated into cash flows considering long-term pro forma dividends, long-term pro forma divided into smaller units, and then more precise time frames set to anticipate patterns of cash inflows and outflows. Notice the monthly sales pattern on this slide, January through June. In the case of Goldman Corporation in our example, let's look at the cash receipts. The pro forma income statement for first half year would be sales divided into monthly projections. There would be an analysis of past sales with collection records showing 20% of sales were collected in one month and 80% in the following month. Here is an example of the monthly cash receipts from sales through total cash receipts. Take a look at this screen. This graphic shows the component costs of manufactured goods considering materials, labor, and overhead. In our cash payments are our monthly costs associated with inventory from manufactured during the period. That would be materials, labor, and overhead. Disbursements for general administrative expenses. Interest payments, taxes, and dividends. And any cash payments for new plant or equipment. Also, there would be assumptions for the next two tables included, and those assumptions would be the costs incurred on equal monthly basis over a 6-month period, and to maintain production level to ensure maximum efficiency through sales volume, which would vary from month to month, and payment for material once per month after purchases have been made. Here is an example of the average monthly manufacturing costs for materials, labor, and overhead. And here is an example for your review that is a summary of all monthly cash payments. The actual budget illustrates the monthly cash flow. It's the difference between the monthly receipts and payments and net cash flow for the month, and this allows the firm to anticipate a need for funding at the end of each month. When we consider our cash budget with our borrowing and repayment provisions, again we have assumptions. The firm wishes to maintain some minimum cash balance. If that balance grows below the minimum, the firm will need to borrow. If that balance goes above the minimum, the firm will use the excess to repay the loan. Here's an example of some of the important characteristics of the pro forma balance sheet. It represents the cumulative changes over time. It's important to examine the prior period's balance sheet. Some accounts will remain unchanged while others will have new values, and that information will be derived from the pro forma income statement and the cash budget. Here is an example of the development of a pro forma balance sheet for your review. Notice the important characteristics that go into the development of the pro forma balance sheet. Here's another example of a pro forma balance sheet for your review. And here's the explanation that goes with that pro forma balance sheet. Notice that the minimum cash balance is as shown in table 4.15, that the marketable securities remain unchanged from the prior period, that accounts receivable is based on the June sales, that the inventory is the ending inventory as shown in table 4.7, that plant and equipment is $27,740 plus $18,000, that accounts payable is based on June purchases, that notes payable is the amount that must be borrowed to maintain the cash balance, that the long-term debt remains unchanged from the prior period's value, that the common stock remains unchanged for the prior period's value, and that the retained earnings is the initial value plus pro forma income, in this case of $20,500 plus $18,524. Hopefully this makes sense to you. So the analysis of the pro forma sheet illustrates, the pro forma statement illustrates growth of $25,640 that was financed by accounts payable, notes payable, and profit, reflected by an increase in retained earnings. The percent of sales method is based on an assumption that accounts on the balance sheet will maintain a given percentage relationship to sales. Notes payable, common stock, retained earnings do not maintain a direct relationship with sales volume, and the percentages are not computed. Here's an example of a balance sheet for Howard Corporation for your review. The percent of sales method is required to reflect funds required and ascertained, that the financing planning is based on notes payable, sale of common stock, and any use of long-term debt. This screen illustrates the calculation for the percentage of sales method for a company operating at full capacity that needs to buy new plant and equipment to produce new goods to sell or more goods to sell. Lastly, the percentage of sales method is about the company not operating at full capacity and needs to add more current assets to increase sales. This wraps up Chapter 4, and I'll see you next week, which actually is not Chapter 5, but Chapter 12.